Hello fellow compounders. Today we'll review 4 dividend growth ETFs for the total return passive investor. And at the end, I'll give you my opinion of which one is the best. This is part 2 of a 2-part series featuring the best ETFs for the passive income investors. Welcome to the Always Be Compounding Club, where we share ideas on how to build, grow, and enjoy wealth. I'm your host Chen. I'm a full-time investor and CFA charter holder. Welcome aboard. Let's get started. In our last video, part 1 of this series, which you can find through this link, I gave you my opinion of the best ETF for dividend-seeking investors. Today, we're reviewing ETFs for those income investors who prefer total returns, which means dividends plus capital gains, instead of focusing on dividends as their dividend-seeking peers from the last video. Remember that a total return portfolio can easily function for income generation. You don't need to stick to a dividend portfolio in order to generate income. I show you how in this video. And I make the argument for investing for total returns instead of dividends because money is fungible. Money from dividends or capital gains is still money. So if you're not going to do the stock picking route and prefer to invest in an ETF, which is a basket of businesses, what kind of ETF would you look for? Since we're looking for total returns, we will not be too concerned about dividend yield. Instead, we will look for ETFs that provide dividend growth, which we will use as a proxy for earnings growth. In order for a business to pay more dividends, it needs to earn more money. If dividends are growing, most likely the business profits are growing also. Therefore, we will look for ETFs that focus on dividend growth, shareholder yield, which includes buybacks, and also the S&P 500 index, which is the go-to fund suggested by Warren Buffett and John Bogle. So here are the candidates we are going to be reviewing today. VOO, which is the Vanguard S&P 500 ETF. BIG, which is Vanguard's Dividend Appreciation ETF. DGRO, which is iShares Core Dividend Growth ETF. And DIVB, which is iShares Dividend and Buyback ETF. There are 10 factors that I look for in a dividend growth ETF. Number 1, the investment selection process. Do I understand it? Number 2, the dividend yield. A dividend yield close to the benchmark yield is okay. Number 3, the dividend growth rate. A dividend growth rate better than the benchmark would be actually nice. Number 4, the expense ratio. What's the cost to manage this fund? How much does it cost to maintain? I am willing to pay up to 25 basis points or 0.25% in annual fees. Remember that fees reduce your returns, so we should be, cost conscious here. Number 5, AUMs. How large is the ETF? I'd prefer larger funds greater than $1 billion because they tend to be more liquid. Number 6, what's the issuer's reputations? We want ETFs from established companies that are not likely to go out of business. Number 7, risk-adjusted performance. How do the returns compare against the benchmark? We should expect the fund to at least track the benchmark. Number 8, composition. How many holdings? What are the 10 largest holdings? How much weight do the top 10 carry? Number 9, diversification. How many business sectors does it have? Is it diversified enough to be the only holding in my portfolio? Will I be able to sleep well at night? And number 10, valuation. Is the ETF sold at a reasonable price? Is the value I'm receiving from the ETF worth the price? So let's begin with VOO, Vanguard's S&P 500 ETF. Number 1, investment selection. For VOO, it's simple. It buys the 500 largest publicly traded U.S. companies weighted by market capitalization. Number 2, dividend yield. VOO has a dividend yield of around 1.6% as of July 7, 2022. Number 3, dividend growth rate. VOO's 5-year dividend growth rate average is 6.08%. Number 4, the expense ratio. VOO has an expense ratio of 0.3%, 3 basis points, which is very competitive. For every $10,000 invested, you would pay $3 per year. Number 5, AUMs. BOO has around $226 billion in assets under management. Number 6, issuer. BOO's issuer is Vanguard. It was founded by the legendary John Bogle. Number 7, performance. BOO's performance is 12.92% annually over the last 10 years and 11.27% annually over the last 5 years, 10.56% over the last 3 years, and it has a 3-year standard deviation average of 18.64%. Number 8, composition. BOO has 505 stocks. The top 10 account for 27% of the fund, and the top 10 holdings are Apple, Microsoft, Amazon, Google, Tesla, or actually Google is Alphabet, Tesla, Google, Berkshire Hathaway, Johnson & Johnson, United Healthcare, and Nvidia. Number 9, sector diversification. BOO's top 5 sectors are technology, healthcare, financials, consumer cyclical, and communication. Number 10, price. BOO's current PE is around 20, which means an earnings yield of 5%. Is it reasonable to be investing at 5% when you can get a 10-year US Treasury risk-free yielding 3%? Maybe. But the S&P 500 is the benchmark to beat. Next, let's review VIG, Vanguard Dividend Appreciation ETF. 1. Investment selection. VIG replicates the S&P US Dividend Growers Index. This means that it selects from stocks that have 3 characteristics. 1. That they have a 10 years of dividend growth history. B. $1 million of daily trading volume. And C. That they are not REITs, real estate investment trusts. The stocks are sorted by dividend yield, and the top 25% are excluded. Also, no stock will be more than 4% of the fund. The index is reconstituted annually. Number 2, dividend yield. VIG has a dividend yield of around 1.99%. Let's call it 2, as of July 7, 2022, which is higher than the 1.6% of BOO. Number 3, dividend growth rate. VIG's 5-year dividend growth rate averages at 8.38%. Number 4, expense ratio. The expense ratio for VIG is 0.06%, which is very competitive. Number 5, AUMs. VIG has around $72 billion in assets under management. 6, the issuer is Vanguard. 7, the performance. VIG's performance is returns of 11.96% annually over the past 10 years and 11.19% annually over the last 5 years, 9.53% over the past 3 years, and it lost 5.62% in the last year, and year to date 2022 it has lost 15.71%. It has a 3-year standard deviation average of 16.08%, which is the lowest among the 4 funds we are comparing. And it's lower than VOO. Number 8, VIG composition. VIG has 292 stocks. The top 10 account for 29% of the fund. And the top 10 holdings are Johnson & Johnson, Microsoft, United Healthcare, JP Morgan, Procter & Gamble, Visa, Home Depot, MasterCard, Coca-Cola, and Broadcom. Number 9, sector diversification. VIG's top 5 sectors are financials, technology, healthcare, industrials, and consumer defensive. Number 10, price. VIG's current PE is around 20.7, which means an earnings yield of 4.83%, which is a little bit pricier than VOO, which has a PE of 20.1. I think VIG is a bit pricey at this level. Next up, DGRO, the iShares Core Dividend Growth ETF. Number 1, investment selection. It replicates the Morningstar US Dividend Growth Index. This means that it selects stocks that have A, 5 years of dividend growth, B, positive consensus earnings forecast. C, a payout ratio of less than 75%. That means that it doesn't distribute more than 75% of its profits for the year. And D, they are not REITs. The stocks are sorted by dividend yield and the top 10 are excluded. So you don't get poor quality dividend payers. The index is weighted by dividend dollars paid out and it's reconstituted annually. Number 2, dividend yield. DGRO or DGRO has a dividend yield of around 2.2% as of July 7th, 2022, which is the highest among the 4 funds that we are comparing. Number 3, dividend growth rate. DGRO's 5-year dividend growth rate average is 9.19%, which is the highest among the 4 funds that we are comparing. Number 4, expense ratio for DGRO. DGRO has an expense ratio of 0.08%, which is higher than VOO's 0.6%, but it's still fairly competitive. Number 5, assets under management. DGRO has around 22 billion in assets under management. Number 6, DGRO's issuer is iShares, a BlackRock company. Number 7, performance. Its performance is 11.3% annually over the last 5 years, 10.16% over the last 3 years, and it lost 3.62% over the past year. And year to date, it has lost 13.49%. It has a 3-year standard deviation average of 17.5, which is lower than VOO's. 8, composition. DGRO has 414 stocks. The top 10 account for 25% of the fund. The top 10 holdings are Microsoft, Johnson & Johnson, Apple, Pfizer, Procter & Gamble, JP Morgan Chase, Home Depot, Merck, Coke, and Cisco. Number 9, sector diversification. DGRO's top 5 sectors are financials, technology, healthcare, industrials, and consumer defensive, similar to BYM. Number 10, price. DGRO's current PE is around 15.7, which means an earnings yield of 6.37%, making it a much better deal than VOO or BYM currently. And the last ETF, DIVB, iShares Dividend and Buyback ETF. I added this one because it's focused on shareholder yield instead of dividend yield. It's fairly new, but it was worth a look. Remember, shareholder yield is dividends plus buybacks plus debt paydown divided by the price of the stock. This ETF only factors in dividends and buybacks. It ignores debt reduction. So let's get on with it. Number 1, investment selection. It replicates the Morningstar US Dividend and Buyback Index. This means it selects from stocks from the Morningstar US market universe that have A, all stocks that have shareholder yield above 0.1%. B, it ranks them by shareholder payout dollars. And C, it takes all securities that aggregate up to 90% of the total shareholder payout dollars. D, REITs are included. So this one and VOO are the only 2 of the bunch that have REITs in them. And E, each security is capped to a maximum weight of 4.9%. And it's all reconstituted annually and rebalanced quarterly. Number 2, dividend yield. DIVB has a dividend around 1.89% as of July 7, 2022. Number 3, dividend growth rate. DIVB's 3-year dividend growth rate average is 5.63%, which is the lowest among the 4 funds. It is not old enough to calculate its 5-year dividend growth rate. So that's why I left it at 3. Number 4, expense ratio for DVIV is 0.25%, a quarter percent, which is the highest among the 4 funds. It's at the limit of how much I'm willing to pay. Number 5, assets under management. It has around 250 million in assets under management, which is quite small compared to the other 3 funds. 6, the issuer is iShares, which is a BlackRock company, same as DGRO. Number 7, performance. DIVB's performance is 11.61% over the past 3 years. It lost 6% in the past year, and year to date it has lost 14.47%. At the 3-year mark, it outperforms the other 3 funds. It beats BOO by about 1%. And it has a 3-year standard deviation average of 19.6%, which is the most volatile among the 4 funds. Number 8, composition. DIVB has 345 stocks. The top 10 account for 24% of the fund, and the top 10 holdings are Apple, Microsoft, Meta, Alphabet, JP Morgan Chase, Berkshire Hathaway, Procter & Gamble, Bank of America, and Johnson & Johnson. Number 9, sector diversification. DIVB's top 5 sectors are technology, financials, healthcare, communication, and consumer defensive. Note that it has some real estate like BOO. Number 10, the price. DIVB's current PE is 14.1, which means its earnings yield is 7.1%, making it the cheapest among the 4 funds that we are reviewing today. So, what's the bottom line? Show me the money. Let's compare the performances. If we had invested $10,000 in the 4 funds at different time periods, we would have the following. At 10-year comps, only 2 of the funds existed for that time frame, VOO and VIG. VOO clearly wins with $33,690. At the 5-year comps, only 3 of the funds existed for the time frame. VOO with 17.06, VIG with 16.99, and DGRO with 17.08 thousand. DGRO wins by a little bit over VOO and VIG, but they're all very close together. At 3-year comps, VOO has 13.5 thousand, VIG 13.14 thousand, DGRO 13.37 thousand, and DIVB 13.9 thousand, making DIVB the clear winner at the 3 years comp. 1-year comp, VOO has 8.93 thousand, VIG 9.44, DGRO 9.64, and DIVB 9.4. At the 1-year comp, DGRO wins. In conclusion, all 4 funds have some merit. DGRO outperformed in the 5 years and the 1 year, and was close with the pack in the 3-year period. VIG was not great, but it wasn't that bad. In the past 1, 3, and 5 years, it kept close to the pack, and it has a low expense ratio. DIVB has the highest expense ratio, but it seems to perform well. It led the pack in the 3 years average. However, it doesn't have much history though. I like the fact that it uses shareholder yield for the selection process. And VOO, over a long period, still outperforms the rest. Also, the portfolio is very stable, so there's hardly any stock rotation, making it a very tax-efficient ETF. Probably it's the most tax-efficient of the bunch, and it has the lowest cost of all, 3 basis points expense ratio. So the winner is, I would pick DGRO as the winner, and I would also stick to VOO as a close second. So there you have it. DGRO and VOO are the ETFs that I would use for total return. If you're looking for a dividend-focused ETF, check out part 1 of this series. The link is right here. If you're an enterprising investor and are looking for dividend stocks, check out this video. Quick disclosure, I own shares of VOO and DIVB and plan to buy shares of DGRO in the near future. This video is for educational purposes only. I am not your financial advisor. You are responsible for your own investment. I hope you enjoyed this video and it was useful. And if you would like me to continue making videos that show you how to invest intelligently and grow wealth, please subscribe, hit the like button, and place in the comments below the words "always be compounding," so I know that you made it this far. It helps with the algorithm and it helps support this channel. Thanks for watching. See you in the next video. And remember to always be compounding. So long. Take care.